Welcome to the weekly video update. This is being prepared April 9th and 10th, where we'll look at the action in the market in the previous week and then see how things look for April 11th through the 15th. And it's actually through April 14th. The markets will be closed on Friday in observance of Good Friday. So we only have 4 trading days this week. So let's go back over the week session and see how things looked. For the week, Monday started out pretty strong. Last weekend, there was some news that Elon Musk had taken a 9% stake in Twitter. We don't really know how much he owns overall, but that was just what was reported last time. And that really gave tech stocks a real boost. And it looked like things were going to be pretty positive. And we saw growth stocks really advance that day. We saw a pretty healthy technical picture that was starting to improve. Well, that ended up being the highlight of the week because we spent the rest of the week pretty much going down after that. And I'll have a chart to show you about that. Then another positive thing that did develop on Thursday, we were going down and we hit support and we saw a midday rebound. And it looked like, okay, maybe here we go, because that was similar to what happened back in March. We hit a low and then just saw an explosive growth or explosive price move to the upside that really changed the whole dynamic of the market. The problem was we needed to see follow through for that on Friday, and we didn't see that. The markets just they went lower, in fact, and just treaded more sideways. So for the week, we ended up being down 1.3%. We were above average as far as volume is concerned, which is kind of interesting because we've been seeing below average volume a lot day after day over the last few weeks. And that just shows real indecisiveness. We have a lot of different indexes that are right at their 200-day moving average. And that is the line in the sand. If we're above the 200-day moving average, that's more positive. If we're below, that's considered more negative. Well, we're right at that level. So people are not really sure. Are we going to go higher from here? Are we going to go lower from here? As far as what we're looking at, the technicals, they are weakening now more on a daily basis. And that's carrying over a bit into our weekly charts. And I'll go through them here in just a minute. Inflation and interest rates are the real focal point, at least economically in the US, and then that comes over into the stock market as well. There's a whole list of geopolitical concerns going on between Russia, Ukraine. We also have different lockdowns that are happening in China. And it's not so much the lockdowns, it's what's that going to do to the Chinese economy? And then how's that going to affect the US economy? Because we buy a lot of stuff from China and we already have supply chain issues in the US. Is this just going to add to that? Well, over the last week, we saw the transportation index just get hammered. It's had a bad couple of weeks. It had been going up nicely. Well, with these new concerns, that's really dragging things down. And I have a chart later on that I'll talk about that. And then the continuing oil debate. Well, as everybody is well aware, if you put gas in your car or try to heat your home, oil prices are really going up. So one of the things that is being talked about is the administration is deciding to release some of the oil reserves. I think it's about 1 million barrels a day. Some people say, well, that's only going to lower prices a few cents. That's not going to really make a difference, but it's going to feel good to the folks in Washington, D.C. They'll pat themselves on the back and say, oh, look at how great we're doing, when really it's not having that big of an impact. Then on the other side, though, the oil reserves are meant for emergency purposes only. And if we bleed out those reserves, what's going to happen if some kind of military action is required? Then on the other hand, if we take that oil out, which was bought at much lower prices, and in the future we look to replenish that reserve, we're going to be paying a lot higher prices. So this is just part of the debate that's going on back and forth. As far as our trend, it's still negative on the weekly chart, but it is weakening. And we've already gone into a weak trend or a trendless environment on the daily charts. We're starting to see that move over into the weekly charts as well. So what are some notes that we can make about the previous week? The big event that happened, other than a few economic reports that were released, on Wednesday, we had the FOMC minutes that were released. And kind of the takeaways from that is that the Fed plans to reduce the balance sheet by about 95 billion per month. They've been adding about 90 billion a month. Well, now they're going to start to sell that off, and they break that down into about 60 billion for treasury securities. And there's also some corporate bonds in there too, as well as a thing called MBS, or mortgage-backed securities. And they're going to start reducing that probably in May. And so that's known as quantitative tapering or quantitative tightening, where we still are in an environment where the Fed is buying bonds and buying mortgage-backed securities. And that has really added a lot of liquidity to the economy and has really helped pump up stock prices. Well, first of all, it pumps up bonds, but they're getting such a low return right now. A lot of that money then works its way over into the stock market, and that was the fuel that has really kept prices going higher over the last few years. What's going to happen to the stock market when that starts going away? Is that going to lead some real downturn in the stock market? We don't know yet. That's just part of the thing that we need to be thinking about and realizing, and then not be surprised if that's what ends up happening. Another thing that they took away from this is probably at the next meeting, it's pretty much looking like they're going to have a 50 basis point move up. That's 0.5%. At the meeting where they raised interest rates for the first time, that was 0.25%. So now at the next meeting, and then the initial idea was they were just going to go 25, 25, 25, 25. Well, now the conventional wisdom is saying, no, we need to go up 0.5% at the next meeting. And we might even need to do more than that as the year goes on, because we have a real high inflationary environment. So that usually means raising interest rates. But at the same time, we have other issues that show that the economy could be slowing down, if not potentially going into a recession, anywhere from 6 months to 2 years into the future, because we have a lot of inverted yield curves right now. So there's this real tug of war going on. And of course, what the Fed is trying to do is have what's known as a soft landing, where that's never really happened, where they raise interest rates just enough to stop inflation, but they don't raise them too much so that it slows down the economy. That's what they're trying to achieve. But with the US economy is complicated with so many variables that are included in all this, it's almost an impossible task to have that soft landing. Another report that came out was the Ism Non-Manufacturing Index, and that has shown a bit of an increase. But what inside of that report, and I have to cough, still dealing with my congestion, there's a thing called the prices paid component, and that is at 83.8%, which is the second highest reading ever. And that's what the financial media loves to pick up on. Ooh, it hasn't been this high and that long. And as you know, when I make these statements or I see these things, it's like that's almost useless information, because what was the context? The other time it was even higher. Were we going up? Were we going down? What was the economy like? What was the geopolitical situation like? What was the stock market like? See, you can't just do an across the board comparison. It makes for an easy headline and it gives people something to talk about and to fixate on, but is it really all that important? But it is still very high. So we're seeing inflationary indications within the ISM non-manufacturing report. And then interest rates. That's really kind of the fixation right now. Interest rates are really starting to rise, and that's really hurting growth stocks. Why does it hurt growth stocks? Because growth stocks grow and they have to borrow money to grow. And as interest rates go up, that means it costs more for them to borrow that money. That eventually leads to their bottom line. They don't have as much in the way of earnings or profits, and that can affect their stock price. So when interest rates are going up, that can have stock prices go down. Now, in a more healthy environment, and I've done videos that show this, where, yeah, the stock market can go up in a rising interest rate environment. Well, we're now at the point where we're seeing inflation that generations have not seen in their lifetime. Unless you grew up in the 70s under stagflation, where you had very, very high interest rates and very, very high inflation, but really no economic growth at the same time. There's a lot of money managers, there's a lot of investors. There are, like I said, generations that they haven't been through that. They might have read about it in a history book, but they haven't lived through that. And so that might make things different this time, where growth stocks are going to go down because of rising interest rates, because we have such a high inflationary environment that we're dealing with. So here is the week. We go back here to Monday, and Monday started off really well. We had that news coming out about Twitter with Elon Musk buying a stake, and stocks took off and had a really good day. Well, that was the good day for the week. For the rest of the week, we saw pretty much a decline into sideways action. We really dropped on Tuesday. It's like all the love that we felt on Monday was suddenly gone. They were almost mirror images of each other. Growth stocks did really well on Monday. They just got hammered again on Tuesday, and a lot of the gains were given back. Then for the rest of the week, we saw more choppy sideways market, with things either gapping lower and then moving sideways. Right in here where you see this spike up, that is when the FOMC minutes came out, and that can gyrate the markets, which it did. Thursday also saw kind of a continuation. We saw interest rates really going up, so stock prices went down. Well, here's where we hit some support, and we had a really strong bounce up off of that. And that would have been really positive if it had been able to carry through into Friday. Well, that didn't happen. We ended up gapping lower on Friday, bouncing around. We shot up a little bit positive. We drifted sideways to lower, and then eventually went negative. So there were some opportunities for things to improve technically that the market just wasn't able to take advantage of. So for the week, the S&P was down 1.3%. Other indexes, the Dow, which are 30 stocks, the bluest of the blue chip stocks, it was down 0.3%. So it performed the least bad. Sometimes you could even say outperformed. Where the tech stocks, Nasdaq really got hit, down 3.9%, with the small caps, the Russell 2000 down 4.6%. And then this is just gives you a illustrative representation of what happened, where the Dow was down the least. And this just goes back over the last 5 days. So my numbers are often quite different. NYSE, and that's holding up fairly well. We want to keep an eye on that. There's also another broad-based index called the Wilshire, and I watched that very closely because that gives more of a big picture look at the market, where the S&P, according to this, was down a little over 2%, mid caps, small caps, and then the Nasdaq is really what got hit the most as the week played itself out. So as far as our sectors for the week, I sorted it from positive to negative, even though we had a negative week. A lot of the value plays, healthcare, energy, staples, utilities, even real estate, those were the ones that performed the best. Those are more the value areas that people get into to be more defensive. When growth stocks are not really working out for folks, they get into these other areas because they either perform well or perform less bad when we're having difficult times. Then other sectors ended up being negative, with tech leading the way lower for the week and discretionary. These two are not seeing a lot of love currently. They were on Monday, but then the rest, it's like a seventh grade relationship, you know, you have it one day and it's finished the next. That's kind of how things played out on Monday, and then spent the rest of the week just fixated more on interest rates. And then here's just another graphical representation for the week. And again, this just goes back to the last 5 trading days, where for the week, healthcare did the best, energy, staples, utilities, real estate, value plays. Those that didn't do as well, we kind of have financials and materials in the middle, but in industrials, but communication, discretionary, and tech ended up having the worst performing week. So let's go over and look at the currentmarketvaluation.com. They did update things over the weekend, where first we look at the yield curve, and then you might go, well, wait a minute, I'm hearing all this talk about an inverted yield curve. What's going on here? There are different yield curves that we can look at, and I have multiple charts that I show in my daily videos. Well, the model that they use for this is the yield curve between the 10-year and the 3-month. Well, if you look at that on a chart, it's not inverted. It's actually going up. So that helps to make this model look better than it is. And overall, it's fairly valued. It's not, it's registering that we're not too expensive or too cheap. Now, you can disagree with that, because there are a lot of other indicators, like here's the Buffett indicator, where it's comparing stock prices with GDP. It is overvalued. Now, it had been higher, but has been dropping off lately as prices have been going lower in the stock market. PE ratio, there's other ways to look at that. Do we look backwards to get what already happened, or do we look at forward earnings? It had been extreme and is coming back down, but it is still overvalued. Interest rates are considered fairly valued, even though they're rising. Historically, they're still very low. And then margin debt, this hasn't been updated in over a month. So, but it just shows that there, in this last report, that there was a real decrease in margin debt. And then mean reversion, which is probably the one that I focus on the most. What's the mean price? Not, which is kind of like the average price. You remember median, mean, if you're back to your math classes. We take that mean price, and then how far away are we from that price? When we get too far to the upside, this turns yellow and then eventually goes red. If we're below that price, then that just means that we're underperforming the mean price of the S&P. Well, it's coming back down after being red. It's turning back yellow and is now overvalued instead of extremely overvalued. Let's look at sentiment. We did have some reports come out that come out every week. This is the American Association of Individual Investors. And I added some more lines on here just to give some more reference points. And after having that extreme negative reading a few weeks back, about the middle of March, and that corresponded with the low that we set, and then we saw a nice skyrocket up from there. Well, as prices have been going up, individual investors are getting more comfortable, and they're a little more in the neutral area. They're not really extreme at this point. But then we saw a decline, and this follows price, because these folks react to what's happening instead of proacting, seeing things before they happen. They react after things happen. So they're getting a little bit more negative, but they're not extreme right now. And then here's another one. This is the bearish fund, the Ridex funds ratio between the bearish funds and the bullish funds. And we're not giving a real extreme reading. We've really dropped back down. I have to cough. This just thing, I've been battling this for like a month, and this thing just will not go away. Well, when we hit that low back in the middle of March, we really spiked up with this ratio. As we advanced, we saw a real decrease in this ratio. and I'm going to have to pause this here. Okay, thank you very much. I apologize for that, but I can't really control that at this point. And I don't have the software that I usually use, so I can edit that stuff out. Hopefully that's going to change here pretty soon. Now, looking at the VIX, this is the fear gauge. It was looking a little more positive. As this indicator goes down, that means there's less and less fear, and the market is usually going up at that point. Well, when we drop below 20, that's usually the upper band of there's not too much fear, there's not too much greed. If we're within this blue line and red line where we can spend a lot of time, that just shows that we're not showing excessive sentiment at that time. Well, it was looking more positive when we dropped below 20. That's more of a static number. Now, on the daily charts, I also plot moving averages because I don't want to rely on just static numbers alone. I want a moving average that can change over a period of time and hopefully gives a more accurate reading of things. But with the declines that we saw this past week, we went back above 20. So we're kind of getting into the fear area again. And then down on the bottom is a bar chart where we went below 20, but then came right back up above that slightly during the week. And then this is the Ulcer Index. As this is climbing, that means there's more and more fear in the market. Well, with the run up that we saw, we're seeing the Ulcer Index start to decline. Now, if things really turn and start to go lower, expect this line to go higher. Another thing to look at is this is the Chicago Fed National Financial Conditions Index. As a general rule, when we're below this black line, that means that the economy's doing just fine. It's not really, people aren't freaking out about things. When it gets above this black line, that's when people are freaking out, or money managers and different economic indicators are showing that things are getting pretty scary. Well, you can go back and see, this was 2008 and how we spiked up. We didn't really see a spike with the dot-com boom and bust. We did spike up in 1990 when we ran into some difficult times. Of course, the 70s and into the 80s were totally crazy. So this thing really spiked up. But look at where we're at right now. Yes, we are advancing, but we're still well below this black line. And this was updated as of April 6th in the past week. So this is just saying, all right, this idea about a recession, the people that manage a lot of money, bond traders, and so they're like, we're not seeing that. We're not really seeing any real problems with the economy. Now, this could spike up quickly. Look at how quick that it went up during the whole COVID plunge. It was like 1 week, everything's fine, and then poof, time to freak out. So this can change. That's why I like to go over it. It updates once a week. And so I like to keep an eye on that. Another thing that we look at is the spread between risky loans and not as risky loans, or and the ability for people to repay those loans. When this really spikes up, that means that we're running into some trouble. And we really saw that back in the financial meltdown. We saw it a bit with the dot-com bust. And then the recession that we went into after 9/11, we saw a spike during the whole COVID plunge. Well, look at where we're at right now. We're not really seeing that spike. So we're not seeing danger signs economically, at least according to this chart. Then another thing that comes out every week is these are active money managers. You can get into a passive mutual fund that's based on the S&P, the Dow, the Qs, pretty much anything. Well, there's another type of managed mutual funds where you have a money manager that goes out and tries to find great investments. And when they're willing to take on more risk, because that's where the reward is, they get into riskier assets, usually meaning stocks. When they're more fearful, and this is one reason why when the market goes down, managed mutual funds tend to outperform passive funds that are based on an index, because the manager's shifting things around and they're being more defensive. Well, right back in the middle of March, we hit this bottom because they're human beings. They react to things too, and they were showing extreme pessimism. And then we started to bounce up out of that. So they started to get back into more risky investments, or basically stock investments. And this is continuing to climb right now. And we're not necessarily at an excessive high point. This can go anywhere from the 90 to 100 range before we say it's looking pretty toppy. We could even go above 100 before it finally ends up turning down. As far as the Fed watch, just to update things here, at the May 4th meeting, it's about an 80% chance that after that meeting is over, the Fed funds rate will be 0.75% to 1%. That's the range. Right now, it's at 25 to 50. Before they raised interest rates, it was at 0 to 25. So, but this can change. We can have some economic reports come out. We can have some things develop before this meeting that really takes this down. But the conventional talk right now is that we are probably going to see a 50 basis point increase at the next Fed meeting. And that is pretty much being shown in this chart. And then this just gives you a historical chart of how these different ranges have gone up and down in probability. And I'm not really talking about this in the daily videos because we're still far away from that meeting, but as I look at them every day, and if they start to really show some movement, not only for the May meeting, but the meetings that'll be happening after that, then I'll start talking more about what the Fed is more likely to do. We're still seeing an increase in the Fed balance sheet. That's quantitative easing. When we start to see this thing go down, that is quantitative tapering or quantitative tightening, when they start to get rid of the things that they've been buying to help keep the economy going. But as of right now, they're still adding to their overall balance sheet. As far as breadth, we saw a little bit of an advance based on price, but we're still seeing some weakness based on volume overall. And so we want to keep an eye on that, because if volume is going down, often that can be a leading indicator. Now, there can be exceptions to that, where a lot of the run up from 2020, 2021, that was led by some of the big monster stocks, where other stocks were not really participating in that advance. They would in sympathy, but the real drivers were the Amazon, the Google, the Apple, all those companies. And so the fact that we saw volume giving us a negative divergence was not that big of a deal. Well, now that we're shifting out of that environment, we do want to keep an eye on what volume does. And a lot of times it can lead price. Here's the advanced decline ratio, where the red line and blue line are just about equal with each other. It's a little more positive because we are above 0. New highs, new lows. We're seeing this is kind of the one improving thing on the daily charts. We're seeing a lot of new highs being set, but that's probably more the value stocks. It's not the big growth stocks that led the way higher. It's other stocks that are starting to take over a leadership role. And those are the ones that are starting to see some new highs. But for the week, we were pretty much sideways. You can see how we just kind of tapped out. Then another thing is the accumulation buying versus distribution. We're right on the moving average right now. And then just while I have this up here, you can see where volume was for the week was just a little bit above average. And then on the price chart, you can see where we are above the pivot and we are above this 50-period moving average. So that all of those things are a bit more positive right now. As far as our trend, the ADX is weakening. It's still above 20, so it's still a trend, but we're starting to fall below the moving average. If you're a little bit more aggressive with this indicator, when the black line goes above the red line, you see that as the trend. Others that are more conservative with this indicator wait until we go above 20 for there to be a trend. Well, now it shows that we're rolling over, but we're still above 20. And that just means that there is a trend, but it is a weakening trend. And it's a negative trend because the red line is on top where the green line is on the bottom. Then another thing is the Arun, where we're seeing a decrease in selling, but we're also seeing a decrease in buying. We are below zero with this oscillator, but we pretty much have gone sideways over the last week. Then the mass index, we're still waiting for this to do something. We've crossed above 27. Now we're waiting to see if this is going to come back down to this dotted red line and generate the second part of its signal at 26.5. And that usually means that there'll be some kind of a big move. We're not really sure what the direction will be. We use other tools to tell us that. But at least this says something might be happening. But it can give some false signals, but it also can give some pretty useful signals as well. Long term, our pivots, it's positive because we are still above the pivot right now. Our longer term trend, it's still slightly positive. The moving average is at 44.45, where the S&P is at 44.88. So we're just a little bit above the 50-period moving average. So that's slightly positive. Looking at our trend, we're seeing a potential death cross with the 13-period moving average getting ready to cross below the 50. And if we see sideways movement to down, that cross will continue to happen. Now, for some miraculous reason, we really shoot up here. This could turn the moving averages around, but that can take some time to develop. Our bullish percent index, and I changed how this looks a little bit to make it a little easier to see, where we had gone extreme positive. Well, we're now coming off of that extreme positive reading. So that's an official overbought signal, which just means we were going up too far, too fast based on the bullish percent index. Then the Chaikin oscillator is also starting to roll over. It's still above zero, so that's positive, but it's starting to go down. Chaikin money flow is also negative. It's been showing a decline. The force index is just still a little bit positive, but showing some weakness right now. The McClellan oscillator, after giving us an extreme positive reading, has been really declining. It's still above zero, and that's positive, but it's also going lower, which could be more negative. Summation index continues to advance based on price, but we're starting to turn down. And it might be a little hard to see, but this has rolled over a bit based on volume, which again, volume can often lead price. Not always, but it does. It can. Our oscillators, which look like they were trying to improve, some of them are still rolling over, where others are trying to cross back positive. Again, I'm not a big believer in using momentum oscillators on weekly charts because of the lag time and because of the way that they are calculated, but I still look at them all the time. The short-term oscillator, I don't really look at the PMO on the top. That's one of our momentum oscillators. I do look at this top part where we are showing a little bit of a decline, but we're still positive based on price. We're also showing a little bit of a decline based on volume, but we are still positive overall. So that could be a little more positive. Then our PMO study just shows on the PMOs that are actually rising has been declining after giving an extreme reading. The number of buy signals that are generating is also declining after giving an extreme positive reading. So you can take this a couple of different ways. We had an overbought reading, and now we're just wearing that off before we're getting set to go higher. Or you see this line going down, it's like, oh no, it's negative. So half full, half empty. And then on the very bottom, those that are actually above zero just declined a little bit over the past week. RSI, it's going down, but it's still above 50. So it's giving us more of a mixed signal right now. The special K is still positive, but could be starting to show some weakness. The STO, this is a little more negative. We crossed below zero based on price and also below zero based on volume. So that just shows that there's potentially a little bit more weakness in the S&P on a weekly basis. Williams percent R, after crossing back above, is that 50? Yeah, I guess it's 50. It turned back down a little bit, but it's still above 50 currently. And then the Williams percent R, it still is looking a little more positive. It's above this 0.5 line and continues to advance. Vortex showing some weakness. The red line is on top, which is negative and advanced slightly. The green line is on the bottom and declining. So that just overall gives a more negative picture between the two. Ultimate oscillator actually advanced a little bit and is above the 50 line. So that's a little more positive. So we're getting a real mixed picture right now. Money flow index, after bouncing back up, has been declining recently and is now below 50. So that's a little bit more negative. Then the percent B, this is how far away or how far outside of the Bollinger Bands are we? Well, we're just in about the middle. We got back to this dash line, which is the midpoint, and now we're starting to roll over. So that's a little more negative than positive. Different charts. Hike and Ashy, we're still looking okay here. We have a lot of open candles currently. The Kegi is also, it's black. Even though it went more sideways, it's still positive overall. On the Renko, we're a little bit more negative because a new solid red box drew for the past week. And our equivolume, we saw a nice lot of open green candles is where we're going up. Well, for this past week, we're seeing a red candle. No change in the point and figure chart. And I tried to change the size of this so it didn't blow up and go all crazy like it did last time. But the last signal that was generated was in the middle of March, and it was a double top breakout. Is that going to be what happens? Well, nothing really changed on this chart in the past week. So we're still working off of that signal. Because remember, these charts are not based on time. It's based on price movement. And if it takes a long time for price to go in one direction or the other, it won't pick up on this chart until that price movement actually happens. The three-line break is still a little bit positive overall, but we're seeing it's not a real healthy bar that we have at the very top there, but it is still going up for the most part. Different trading systems. Our Elder system is still positive and above this moving average right here. So that's positive. And the SER is positive as well. The dots are below. So there's a real mix right now. As far as the broad market, here's the S&P itself going up and then falling back a little bit. Here's the mid caps, which are pretty much still going sideways, and the small caps are pretty much going sideways, with small caps now in danger of getting to the lower end of this sideways band that we've been in for a long time. All stocks, they tried to show a bit of a bounce by coming up to the moving average, but then lost 1.5% over the last week. So that is more negative. You can see down here where volume did drop off and was below average. Mid caps, again, a lot of these are just dancing around real critical areas. We had a recent death cross and we are below both moving averages. So that's more negative. Small caps, also recent death cross, we are below the moving averages. So that's a little more negative. In the Dow, it's just kind of bunched up right here. It's been holding up a little better, but it's not really moving right now. And we're potentially at a death cross. And then I just want to make sure I have this chart. This is actually a thing called Dow Theory, where The top is the Dow Jones Industrial Average, and we look at charts of that all the time. This middle chart are the transports, and you can see the previous week we had a real decline. Well, that followed through with the transports in the past week, mainly because of the supply chain issues, oil prices, a lot of the different news coming out of Canada. Some American truckers are worried, is that going to bleed over into the US? So there's some real problem. And then you had some of the big brokerage firms actually downgrade some of the transport stocks. So they're looking more negative. So we're seeing a negative divergence right now. The Dow's been holding up, but we're seeing a real decline in the transports. We're down at the bottom, and I usually put utilities as part of Dow Theory. It's been doing really well lately and is still going higher overall. The reason I brought up this chart was really to look at the transports. Then our Nasdaq, again, we're kind of dancing around in between the two moving averages after having a recent death cross. Nasdaq 100, kind of the same thing, in between the two moving averages after a recent death cross. The NYSE also holding up, but seeing a recent death cross. The Wilshire, same thing. It's like I could be showing the same thing over and over again here. That just shows a lot of the indecisiveness right now. And that's why, even if you are a longer term investor and you use weekly charts, it might benefit you to, if you can, to start watching some of the daily videos that I do, because we show more of the nuances of how things are changing in those videos. Where here you can just look at this and go, not much is going on. Well, if you look at the daily charts, there is a lot going on right now. Then our FANG stocks, they saw a lot of love early in the week, not as the week went on, and ended up being down over 5% for the week. They're down below both of the moving average after having a recent death cross. ARK, down over 10% in 1 week. My goodness. It really looked like ARK was starting to break out. Well, it's now having some problems. Then the big software companies, they pretty much have been going sideways, but they're below this moving average, which is also going lower. Broad market things to look at. The CRB on a weekly chart, it was up 1.71% for the week. And this is why we're seeing a lot of inflation, because we're seeing commodity prices really going up. Gold just kind of, it just amazes me. I listen to podcasts, I read articles, and anytime gold has a little bit of an update, these folks are just sure that gold is breaking out. And even if it goes down, it's like, well, it didn't go down as bad as other things, so that could be really good. It's like you can spin it any way you want. Now, I'm not here to bash gold or love gold. It's a real tangible asset, and it can be a very good investment, but it can be a very difficult investment if you are using this as a trend-based system where you're looking to buy low and sell high, because it just gyrates all over the place. And the same thing with silver. I mean, ding, 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 it looks like bumper cars going around here. So it can be really frustrating to look at some of these precious metals and say, well, I'm going to get in and then get out, because there's so many fake outs. There's moves that look like are really going in one direction or the other, and then they just stop and then change. But sometimes they go on for a while. It's just a really difficult market to follow, in my opinion. Oil for the week actually was able to close down below 100 at 98.26. The dollar, which is just screaming higher now, and again, the dollar may be used as toilet paper in the future, but not right now. It has been holding up. It's also a fiat currency, which means it's not backed by anything. Well, all of the major world currencies are fiat currencies, and it just means that the US dollar is the least crappiest of all the crappy currencies out there. And it has been showing some strength. And we actually got above 100 for a while on Friday. We fell back below that, but we on this weekly chart are just showing a really solid uptrend. And For most of 2021 and into 2022, the dollar's been holding up and actually going higher. It's going to be interesting to see. If we break above 100, that means that the euro's at about 108, 107. It's going to kind of be interesting if things get to the point where the two meet each other. We'll have to see. Relative studies. If you're in bonds instead of stocks, you have been very disappointed for a long time. This is the ratio between the two. And it just shows, even in this environment, bond prices have really underperformed stock prices, even with the difficulties that have been hitting the stock market. Then this is a monthly chart, which just shows a breakout of the ratio between stocks and bonds. This is showing that if you got into stocks, you are you're performing much better than bond prices right now. And this was pretty significant. This goes all the way back to 2000. And for us to break above that and now stay above it and continue to go higher, that's positive more for stocks. But this is a very long-term chart. This is, and I kind of changed this a little bit. This is the intermarket analysis chart, just going back to the beginning of the year. So it's year to date. And this just shows you how things, we're getting far enough into the year now where this actually kind of means something. Where oil is up just under 35% since the beginning of the year. Gold has been up about 6-7%. The dollar has also been doing fairly well since the beginning of the year. The S&P, not so much. It's down on the year, but not even into correction territory. What's really underperformed are bond prices, because as interest rates go up, that means bond prices are going down. And this is the TLT, which is kind of based around the 20-year bond, in between the 10 and the 30. Then the gold to US dollar ratio is not there. And this is another strange thing. It typically, when the dollar goes up, gold goes down. When the dollar goes down, gold goes up. Well, some days we're seeing them both go up together, and other days we're seeing them go down together. So it's really not helping us with this ratio, but it looked like we could have been breaking out here, but we have overhead resistance. So the ratio between gold and the US dollar is really not showing much movement or much improvement currently. This is gold against the S&P. It really looked like gold was breaking out against the S&P, but has since fallen back. Although it did bounce up a little bit in the past week because gold had a better week than the S&P did. And then this is low volatility stocks. These are more the value stocks. And when money managers or investors want to get more defensive, they get out of the big growth stocks, the volatile stocks, and they get into the low volatile stocks. Well, this just shows for 2022, even though it's been not a straight line, and there's been some scariness along the way, so far, the low volatility stocks have been outperforming growth stocks or the rest of the SPY. And then here's growth against value. As this declines, that means growth is underperforming. When it goes up, that means growth is outperforming. Well, growth has been showing some weakness and more below the moving average here. And then here's the Nasdaq 100 against the S&P 500. Nasdaq 100 has got a lot of tech stocks in it. It is underperforming the S&P 500, which kind of still just reinforces our scenario that growth stocks have been having a lot of problems. Here's the S&P 100, the biggest stocks that make up the S&P 500. They have been underperforming recently against the rest of the S&P 500. And then discretionary, the things that you would like to have against staples, the things that you have to have. When this is going up, this is usually meaning a better economy. This is when you can buy that jet ski, when you can get that gym membership, when you can buy that extra vehicle, the things that just make life worth living. Well, when times get tough, we see the discretionaries go away because people now have to put their funds towards staples, food, toilet paper, toothpaste, those kinds of things. And so discretionary has really been underperforming staples, and even saw a bit of a decline over this past week, and we're below the moving average. This, and you might want to pause this, I'm showing this on my daily videos. These are all the different yield curves on here. And this just shows when they go below this red line here, that means they're inverted. And it's happened a lot of times, and I've gone back about as far as I can with it still being able to look okay. But what I want you to look at and make your own conclusion is, after we've gone inverted, and what is really nice is if all of these yield curves invert at the same time. What we're seeing over here is this one just went back to not being inverted. This one's actually going up. This one's inverted. This one's inverted. This one's going up. So it's not like we're seeing across the board uniformity here. But at those times when we did see an inverted yield curve, look up here at the S&P and see what happened after that. Not necessarily in the long term, but a lot of times once we get how do I say this? Uninverted, verted, is that even a word? Once we get out of that type of an environment, we still have some time before something economically, typically a recession, will happen. And that can be a real powerful time for stocks. So that's why we're watching this. If we can get all of these yield curves back above this, could we see a pretty solid up move in the S&P? It may not last a long time, but it could be explosive. So, and right at the end of this video, I have my email address. If you want me to email you this chart, I'd be more than happy to do that if looking at it right here is not enough for you. But I'm updating this every day. This is actually a daily chart. This isn't even a weekly chart, but this is something that you probably want to keep an eye on, just to look to see how we're doing with that. It doesn't mean we're going to break on through to the other side with stock prices, but that has been what has typically happened in the past. But we're not at that point yet. And we're seeing a real contradiction with yield curves right now. Okay, so what is our outlook for the upcoming week? The major economic reports that'll be released. We got some big ones this week. We have CPI on Tuesday. That's the inflation rate. And of course, then they'll come out with that. The markets will freak out. Then we'll have what the inflation rate should be based on how they used to calculate it. And then we have another very important report on Wednesday. That's PPI. That's the producer price index. That's what people are paying to make things. And then Thursday, we have retail sales, another big report. And then we have consumer sentiment. How are people feeling about things? Of course, all the different geopolitical events, Russia, Ukraine, which again, this is really sad on a personal level and on a historical and societal level. But why I bring it up in these videos is, what's that going to do to the stock market as well? Because if there are positive things coming out, that can help, at least in a very short-term environment, give some support to stocks. If some negative news comes out or something escalates, that could have a shorter-term negative impact on stock prices. What's going on in China, especially with the lockdowns and the whole supply chain issues, the yield curve saga, which continues to play out, and then the oil things that I talked about earlier. Those are some of the big, and then something could be added to this very quickly. But these are the kind of running scenarios for right now. And then also, as I mentioned, the stock market will be closed on Friday, April 15th, for Good Friday. So what are our different scenarios? And again, I usually have an up scenario, a down scenario, and a sideways scenario, because those are the only three things that can happen. And most people just gear themselves for what they're trying to do, meaning, and most people want to buy low and sell high. So they just throw the whole negative scenario. They didn't even think of that. Or what if we go sideways? They may not even think of that. Well, as part of my program and what I do personally and what I teach others to do is We need to play out all three scenarios at the same time and then adjust this as things change. Where what could make stocks go down from here in the coming week? Rising interest rates. That had a big influence in the past week. So if we see interest rates really rising, that could help stocks go lower. If we see interest rates falling, that could help stocks go up. But that's more of a negative right now than a positive. And then the different yield curve concerns that I just addressed, that's right now looking like it's more negative. Once we get out of that inverted situation, the yield curve concerns, I'll probably put that down into the up scenario. And then we are seeing broader markets and the internals starting to weaken, just as we're seeing a lot of our indicators showing some weakness. That shows that we're just in a more negative environment right now. And so that could help prices go even lower. And with our technicals that are just showing that, yeah, there's some positive things and there's some things that are holding up, but there's a lot of things that are right on the edge of the knife right now. They could go either way. Okay, what are some things that could help the market go up from here? And if you spend some time looking at that chart that I just looked at with the yield curves, you'll notice that there is often a real positive boost in stock prices after we get out of these inverted yield curves. So if that starts to happen, we might see prices really shoot higher. The one problem we have with that is we're not seeing across the board inversions right now. Then our different oscillators, some are positive while others are looking to improve, but others are weakening and some have already turned negative. So we're kind of getting an across the board mixed picture right now. But again, some of those still continue to be positive. If we see follow through buying, that will help the overall technical picture. And then we have our moving averages. If they're below current prices, they can act as support. If they're above current prices, they can act as resistance. So right now, it's kind of hard to come up with some real viable things for the positive scenario, other than that's what the stock market tends to do. If you look at a 100-year chart of the S&P, you'll see that, yeah, there were some downtimes, but it does have a tendency to go up. Okay. And then sideways, and this on the daily charts, this is kind of the working scenario right now. We have hit a sideways, choppy type of an environment where the ADX on the weekly chart continues to decline and possibly could go below 20, which would mean we're in a sideways trendless more market where we see a real slowdown in price movement and some choppiness going on, where some folks that implement different strategies, that's when you do more of the market neutral type of strategies. Then just be aware some of the different videos that are available. Right now, I'm doing the weekly video. Every day I do a full length daily video, but that can be 40, 45, 50 minutes long. And some of you don't have the time to watch that. And they are freely available on YouTube, at least for the time being. Now that's going to change at some point, but for now they're freely available. And then I try to do about a 10-minute video, which works out to be 11, 12, 13 minutes. Where I just go over the highlights. So what you might consider doing is watching the snapshot video first. If you're like, it's kind of interesting, let's go see what he was talking about. Then go in and watch the full length video and then the other weekly video. I'm just not going to be able to get to some of these other monthly videos right now. It takes a long time to put these things together, and I just don't have the energy to be able to do that, or my access to the equipment that I usually use for those things. So thank you. I hope that you have a very good week. I hope that, like myself, you've enjoyed the opening of baseball season and have a really, really good week. And I will prepare the next video after this week's session.